First is the price disinflation recession, crude tumbling, which has, it kind of dovetails with price disinflation, DC drama, and the relevance to markets. So hi, and welcome everybody. Welcome to the week ahead. I'm Tony Nash. This week, we are joined by Seth Golden, Tracy Shuchart, and Marko. We've got some key themes this week. First is the price disinflation recession, which is a really interesting concept that Seth's been talking about. I also want to talk about crude tumbling, which has, it kind of dovetails with price disinflation. And then we're going to talk with Albert about DC drama and the relevance to markets. So before we get started, I want to let you know about a new free tier we have within CI Markets, our global market forecasting platform. We want to share the power of CI Markets with everyone. So we've made a few things free. First, economics. We share all of our global economics forecasts for the top 50 economies. We also share our major currency forecasts, as well as Nikkei 100 stocks, so you can get a look at what do our stock forecasts look like. There is no credit card required. You can just sign up on our website and get started right away. So check it out, CA Markets free, look at the link below and get started ASAP. Thank you. Seth, thanks for coming on. First time,
thank you.
Really appreciate it. It's great to have you. I've been following you for a long time and I love your Twitter presence. So I saw your tweet about the NOPE index and rising PMIs. Your expectation is for a price disinflation recession, which kind of is at odds with what kind of Albert's baseline hypothesis, I think, but not a volume-based recession, price deflation-based. So can you walk us through that? So I've got that tweet up on the screen now. If you can walk us through kind of the your NOPE index tweet.
Yeah, so the NOPE index was actually developed by the Lighthold Group's Jim Paulson, who retired recently. But it essentially tries to strip out the sentiment factor within these soft, the soft data. The ISM is a survey based report. And I think what gets, what kind of becomes a greater magnitude in these survey data is what's happening at the most basic level in price. So what the NOPE index does is it takes the new orders, that's the no part, and then the price, which is the P part, and it basically takes the new orders and subtracts it from the price. Because when you look at the questions within the survey, the ISM, whether it's the manufacturing survey or the services survey, there's never any good price. So there's always this underlying bias within the ISM that is lower bound as opposed to above 50 or expansionary. So Jim Paulson created the NOPE index, which says, hey, focus on this. It's already soft data, but let's see what's really going on in the economy. So if you take the actual new orders and you subtract them from the price, whatever the reading is, if it's above zero, you actually typically have a better manufacturing situation than maybe the overall index is implying, the ISM manufacturing index is implying. The threshold or line of demarcation, if you will, in the NOPE index is zero. So a reading above zero is typically expansionary, and typically that is good for the S&P 500. The forward S&P 500 returns on an annualized basis, when the NOPE index is above zero, is about 13%, I believe. So, it's a good gauge not only of what's going on in the economy, but what could possibly foreshadow market performance going forward. So I know that we've had this seemingly recession in the manufacturing sector, but there's various data that says not even close, right? If we look at just the ISM, if we look at the S&P also, their measure of manufacturing They're both under 50, which technically is a recession in those particular industries within the economy. But the reality is, if you look at, let's say, the St. Louis Fed, the total manufacturing output in the United States has been booming throughout from 2022 and through this calendar year. But we're not getting the manufacturing inputs that we usually do get, which are driving this manufacturing expansion. Usually it's the refining capacity, and usually there's some various variables of goods production that is taking place, textiles or otherwise, that are driving the ISM and S&P manufacturing data. But we have this dynamic, since 22, where it's actually construction manufacturing, as well as electronics manufacturing, that is driving this kind of boom in the total manufacturing here stateside. So I'm not necessarily looking for, a recession based on this NOPE index or what have you. I'm just trying to define what is actually going on through the NOPE index. Is it a real recession in manufacturing and or services? Or is there underlying strength that just isn't being realized by the ISM or the S&P manufacturing indices?
Okay, so you're saying that the manufacturing volumes are continuing to rise.
Correct. And that's the most important thing about this. The NOPE index is that it strips out the price sentiment, basically,
right?
And gives you what's actually taking place in new orders. Because if you subtract the price and you're above zero in the NOPE index, you still have an expansion situation in manufacturing. You don't really have a recession.
Okay, so let's look at this chart.
The actual price that is influencing how respondents are actually, answering the questions in the survey.
Okay, so let's look at this second chart you sent me, and I want to talk about that, and I also want to put the price layer on that because I want to make sure that that's not missed. So you sent me this chart: recent rise in U.S. manufacturing construction driven by computer, electronic, and electrical sector. So since these two acts were signed, the CHIPS Act and the IRA signed,
right,
we've had a spike in computer, electronic, and electrical manufacturing, right?
Correct.
And so that's good, right? That's good for U.S. manufacturing.
Right. You're getting a lot of transactional volume through that fiscal policy initiative, getting a lot and minimal. I mean, there is some price appreciation in there, but it's nowhere on the scale of, let's say, what we see in refining prices through that manufacturing capacity.
Okay. And then where do you pick up the construction? Oh, manufacturing.
Yeah, you're getting materials. And that's another way that you can kind of validate that this is, those aspects or industries where we are seeing, electronics and computing and construction. We know construction materials and whatnot have actually been disinflating for more than a year now, whether it's lumber, sheetrock, concrete, all of those necessary construction inputs are actually disinflating for more than a year, but the transactional volume is basically superseding the price disinflation. Hence, you're still getting this boom in manufacturing overall.
Okay, so based on your thesis, so in 22 and the first half of 23, we saw manufacturers and services firms able to grow their margins because of the inflationary kind of tailwinds, right? They could add margin, they had their top line growing, they had their bottom line growing, and they didn't really care about the volume of transactions, many companies, because they were still hitting top and bottom line numbers that were better year on year, right? So now you're saying that because of disinflation, that margin is collapsing, and those volume of transactions matter as much or more than the price itself.
Right. Yeah, that's a great way to summarize it, because when you have this kind of volume, you get this kind of a reading in the total manufacturing layout, but it's in sharp contrast to what we've seen in ISM. because there's no price situation that is ever really good for the respondents. So take, for example, we had an inflation boom. We got the ISM up to 60. What was it? It was there for what, 1 month, before it collapsed, because the respondents know this can't last forever. I can't push my cost onto the end producer and then the consumer. So I'm going to start responding negatively because I know there's an inevitability in this inflationary boom. Well, okay, so then the reading starts coming down. So there wasn't, even in inflation times, that's only going to live for so long. Then you get into disinflationary situation. And again, well, prices keep coming down. Now my profit margins, as you were alluding to, are also coming down. I've got to rely on volume. But how do I increase demand, right? The number one problem for a CEO, every single morning, he's always thinking about, I wake up every morning, I've got to figure out how to increase demand. So these ISM readings, they're so sentimental, and it's always focused on price. One way or the other, price is bad, always. Mm-hmm. So the NOPE model does a great job of distinguishing the true strength and what the trend is in manufacturing overall.
Okay, so, and Albert, I want to bring you in here in just a minute, but I have just a couple more things with Seth that I want to throw on through. Okay, so we've gone from a very low interest rate to a significant interest rate rise over the past year. We've gone from very nice margins on marginally lower transaction volume to thinner margins on transaction volumes that may or may not be increasing. So when we take those two worlds and we look at the valuations that companies have had, okay, we had really nice valuations in a low interest rate environment with high margins. Now we're in a higher interest rate environment, and I assume a higher for longer environment, okay, where we have lower margins and the transactions may or may not be increasing. So what happens to valuations under your hypothesis? What happens to equity valuations in general, without talking about specific sectors, but what happens in general?
All right, yeah, if we just use the benchmark S&P 500, the consensus is that valuation should compress lower, right? So far as the margins are concerned, it's a bit of there's a bit more nuance there, because while the actual margins per sale may indeed decline, the total profitability may not follow suit, or the earnings per share may not follow suit, because we have this dynamic of higher rates where parked cash, be it households or corporations, is earning millions upon millions and billions every single month. So you have this free cash flow that also has to, work itself way into the valuation model. Again, the consensus belief is that higher rates, higher for longer, should compress the earnings multiple, when in reality, that has been the exact opposite. If we go back to let's say 1960s, 1970s, all the way up to the early 1990s, the S&P 500's multiple was actually higher over a good 23-year span. I think it was 17.7 times, from the late 70s to the 1990s, in that higher rate environment than even where we are today after the Federal Reserve's program here. And now we're at 17.4. But of course, we won't know where we'll be going forward. But there's not hard and fast data suggesting that the multiple should compress, because we're not even where we were back in the 70s or 80s when it comes to the federal funds rate, let alone, let's say, the benchmark 10-year Treasury yield. I don't fall into the camp, that aligns with a compressed multiple. If you look at the PE multiple, if you look at the CAPE ratio, they do nothing but expand over time. That's the history of multiples. They expand over time, mostly because for every dollar that goes toward wages or whatnot, we get that much more productivity, so we have that much more cash flow. So with that being said, the common pushback is, no, multiples don't look at, the peak. We still haven't made it back to the peak of the dot-com period. Okay, so fine. X.com, that hyperbolic event or parabolic event, multiples indeed expand over time. So who's to say that we are not in that, new period, this post-pandemic period where we once again jump the shark, because there's always this jump the shark moment when it comes to PE expansion. In real time, we shun it, we belittle it, we berate the multiple expansion. It's only in hindsight that we realize, oh, we just took a leap.
Yep.
So that's how I kind of look at it. Secondarily, I say, if you look at the long-term history of the, of yields, they go lower over time.
Right.
We might be in this vacuum moment where we're becoming prisoners of the moment, given the, the monetary policy initiatives. But in hindsight, again, we look back and we say, well, of course, the 10-year yield, lower over time. It's just a matter of when it finds that new lower low bound territory. So I'm comfortable with saying, and if in fact we finish at a 20-time multiple here this calendar year, over the trailing 5-year period, the S&P 500 forward PE multiple will have averaged 20 times for the first time in history, hence the jump the shark moment.
Very interesting. All very sophisticated. Thank you so much for this. Albert, I know you are not, well, I suspect you're not in line with the disinflationary underpinning of Seth's hypothesis. Can you walk us through that?
Yeah, nope.
Okay.
I've been wrong twice before. No, I'm only kidding.
I don't even want to discuss disinflation until wage inflation is under control, and that is nowhere near getting control at the moment. And on top of that, inflation in the last year and a half has only shown that companies can earn more, put earnings, through the roof. So until I see wage inflation actually coming down, I don't want to talk about disinflation. And to be honest with you, I can't see it. Even the CPI prints have been completely nonsensical. Goods are just still 17 to 20% higher than they were pre-COVID. Energy, as much as they want to push it down, energy is just bursting at the seams to go back to 100 on the Brent. So I can't see a pathway for disinflation. But of course, I'm only talking for the next 6 to 12 months. After that, that's just a different era, in my opinion.
Heads up for a short break.
Are you using the potential of AI in your portfolio management strategies? With an impressive 94.7% forecast accuracy on average, you can confidently integrate AI into your approach with CI markets. Visualize the potential volatility of your portfolio over the next 12 months and gain insights into specific assets that might experience fluctuations. This empowers you to make informed decisions on when to buy, sell, or hold. CI Markets covers a wide range of over 1,600 assets, including stocks, commodities, forex, indices, and economic indicators. Imagine running limitless portfolio scenarios to optimize your gains. Curious about the outcome of removing or adding certain assets? Wondering how your portfolio might evolve in the next 3, 6, or 12 months? CI Markets equips you with answers to these crucial questions. Whether you seek a streamlined portfolio analysis, wish to explore diverse scenarios, or aspire to track your investments with precision, CI Markets is the ultimate tool for you. Ready to learn more? Visit us at completeintel.com/markets.
Thank you. And now back to the show.
So, Seth, do you have a timeline on yours? Are you thinking 24, or what are your thoughts on the timeline?
So far as getting to the Fed's target inflation?
No, getting to this disinflationary environment that you're talking about.
Philosophically, obviously, Albert and I disagree, and I understand where he's absolutely right. We have absolute inflation. That's all we actually ever have. But in terms of what's being measured by CPI, PCE, and PPI, consumer price index, and producer price, they measure rate of change. So it's the month over month or year over year. So philosophically, I think we agree on the fact that there's always inflation, but it's a matter of, what's being measured is the rate of change of that inflation. So do I see that decelerating or deceleration continuing? Yeah, I would suggest I see that disinflation or deceleration in the inflation rate continuing through the end of this year and at least for the better part of 2024. And so far as the wage inflation is concerned, we are starting to see an increase in the labor participation rate, which will facilitate some of that, at least to some degree, that deceleration in wages. This morning's report may be a prime example, or the last 2 monthly reports, in fact, might be a prime example of an increase in the labor participation rate working in favor of reducing that overall wage inflation.
Right.
Yeah, I just don't take those numbers at face value. I'm just over the fact that CPI is at whatever 3.3%. I mean, they've changed the weighting of it. They use the BLS deflators to manipulate the numbers on unemployment. The revisions come in every 3 to 6 months later that shows that it was actually worse than they were reporting. So like I said, until wage inflation, in my opinion, gets sorted out and they actually have logical political policies to address the oil and gas and energy markets, I don't want to even discuss disinflation in my opinion.
Interesting. So Seth, well, I do think that your thoughts about the volume of manufacturing is very interesting. I'm really intrigued by the disinflationary underpinning of it and how that could drive things. I think that's very, very interesting. Definitely not a consensus view right now.
If you get disinflation, like he's saying, 6 months later, we're just going to have another inflationary event because people are going to go out and buy everything. I mean, houses, goods.
If there is, I agree. One of the caveats or antithesis that I put into my models does center on the resilience of the consumer, the strength in the labor market being like what it is, and just the monthly. And I think it gets way overlooked in terms of people that have been calling for a recession, since last year. It's just the Fed is actually stimulating while it's trying to ease the economic situation by tightening. We're not as rate sensitive as we used to be. Probably the least rate sensitive economy as a whole, households, corporations, in history. So, you have all these people that have fixed rate mortgages at 3% and 4%. So the Fed raises to, 550 basis points. What do they care, right? It's not really affecting them to any, monthly bill payment degree. And now they take that, their savings and they put it into a money market fund for 5 and 6% of monthly income coming. So the Fed is tightening while these people are actually seeing the benefits of the tightening cycle, and unless you say, well, the service industry, that's where the real inflation is. And I would totally agree. I mean, you go to any restaurant, you go to, even some of the lesser Darden restaurants, like an Olive Garden, you can't get a chicken Parmesan for less than $25. And your boy likes chicken Parmesan. And and I'm trying to feed a family of 4 out at the Olive Garden for dinner. And, you get a bill for $150 and you're like, whoa. But the consumer's spending.
You also can't forget what the government is doing, right? Fiscal policy is doing. I mean, the IRA Act is very inflationary.
Yeah, I mean, for me,
it's butting heads. So I just don't see disinflation either at any point soon, except for maybe what the Fed is looking at in their core. But it's hard for me to kind of get on board with this disinflation theory.
It's for me, it's like a double-edged. Everything that Seth says is most likely correct, right? But the flip side is like there's double-edged swords everywhere. Like if they start, if you have disinflation, let's say housing starts coming down, or they have rate hikes coming down, mortgages coming down. You have such low inventory of homes in certain states that they get snapped up like this because people are just cash rich at the moment. They sold whatever they did, or their stock market. They've had calls on Nvidia, made them $10 million, and they come back and they start buying things cash. So you're right. They don't care about rates at all.
I was talking
don't care about it.
I was talking to a mortgage broker earlier this week, and I said, "How is your business doing? Has it slowed down?" And they said, "Oh yeah, a lot. It's slowed down a lot." But they said most of the buyers that we're seeing are cash buyers.
Mhm.
So what you're saying, Albert, is right. People are not taking out a mortgage; they're using their cash to buy a home.
Mm-hmm.
Has the volume declined? Yeah, it has.
Yep.
But I think that what the Fed has done with interest rates is working because you have these guys with 2 and 3 and 4 Airbnbs who are not seeing the occupancy that they saw a year or 2 years ago. And because of the higher mortgage rates, those houses are eventually going to have to come on the market because they can't service those mortgages, right? And so those will come on at a lower rate. Will they get snapped up for cash? Maybe they will. Maybe they'll stay on the market for a while longer. But I do think that the game that the Fed is playing is a kind of a medium-term game, and it's slow to get to where it's going. So I'm not, I don't want Seth to feel like he's being ganged up on. I'm actually.
Oh no, please.
Yeah,
I
No,
always do. I'm fine with the contrary.
It's good to test your theories on the other
Yeah.
side. There's no
I'm
question
partially in
about
that camp, Seth. I think one day in 24, we could wake up and the disinflationary part of our hypothesis could be very true. It could be, April, May, something like that.
Look,
Wake up and boom, we're in this disinflationary world, and people are just like, wow, we've got high rates, but we've got my Olive Garden dinner is now $15 instead of $25. Maybe that happens, right?
I think that Seth is right. I just don't know about the timing. I don't buy it for the next 6 months for sure. On the next 12 months, 50-50. 18 to 24 months, absolutely. That's
50-50. So that's a win. Take the win.
Well, it's just because it's an election year, right? Because it's an election year, and political policies always, always want to be. They're always inflationary. Food, corn, energy, all that sort of stuff, and then mixing it up.
No president has been reelected when there's been a recession.
A recession, exactly.
Yeah.
They're going to do everything they can to halt that recession.
Interesting. Tracy, I want to bring you in on this while we're still on this first topic. You had a great tweet about U.S. manufacturing rebound stretching diesel supplies and pushing up diesel prices. So with Seth's hypothesis about the manufacturing volume coming back, which is great, how much of an impact do you think diesel prices will have on overall inflation readings? Is that a big driver of inflation in the U.S.?
Well, I think that, diesel runs the economy, period, end of story, right? So it has everything to do with manufacturing, with transportation, with agriculture. So it is at the heart of what makes the economy go around, essentially. If you want to move anything anywhere, if you want to produce anything, you're going to need diesel. So of course, that's going to make a big impact on inflation. That said, that energy is not part of what the Fed looks at conveniently. And so that may not figure into their metric when they're looking at core inflation, so to speak. But does that impact the consumer? Absolutely, that impacts the consumer because those costs are obviously passed on to the consumer.
Yeah, there are secondary, tertiary impacts, of course, that are passed on to consumers, or that, service industry people need higher wages because gas prices are higher and so on. Last night here in Houston, I noticed our gas prices were under $3 for the first time in a long time.
Here in Florida, north where we are as of last week, $2.99 at one of the local stations.
Yeah, so if you're on the coast, I'm sorry guys, but you know,
So I'm like, sir, our gas is not there yet, but
right.
it has come down, obviously.
Yes.
But we're not really having a gasoline issue so much as a distillate issue, and people have to seem to separate those two,
Right.
because it's not gasoline doesn't run the economy, distillates.
Just listen. You're right.
Heads up for a short break.
In the fast-paced world of investments, staying informed is the key to success. Introducing CI Markets Free, your source for AI-powered forecasts. With our free version, you get access to powerful tools that help you make informed decisions. Join a community of savvy investors. Analyze market trends. Plan your investments strategically. Stay ahead with monthly forecasts, compare assets effortlessly, and download data for your analysis. Don't just take our word for it. Our users love the valuable insights CI Markets provides. Get started today with CI Markets Free. No credit card required. CI Markets, your source for AI-powered forecasts.
Thank you. And now back to the show.
So let's look at those fuel stocks. So you sent me a chart from Morgan Stanley and the EIA looking at fuel stocks in the US. And so they look to be at definitely lows within a 5-year range for 23. That's the dark blue line on the chart. So can you talk us through, since we do have low stocks, would the, if we see this rise in the volume of manufacturing in the US, would it be almost this bullwhippy rise in diesel prices because of that surge in demand?
Absolutely. I mean, obviously, you're going to see knock-on effects of that, even though we've seen prices come back. We just had Russia this morning decide they're going to allow diesel pipeline exports. That's not all of their diesel prices. Remember, on the 21st, they said that we are stopping all gasoline and diesel exports, which really affects Europe more than anything. But they did come out this morning and say they are going to allow pipeline diesel exports, but still no gasoline exports. So that did alleviate some of the pressure across global markets. You saw some of those those fuel prices come down, those diesel fuel prices come down globally. But that said, there's still a global crunch. And if we look at countries that are reporting, so OPEC countries, for example, because their reporting is, the US reporting is the best, but they're next. And if we're looking at what they're selling, their light sweet barrels, we'll take Nigeria, for example, their light sweet barrels are, not really selling. There's a lot of pressure on light sweet right now because all you can make from that is a barrel is gasoline, essentially. But if you look at their heavier barrels right now in countries that produce crude oil that can be cracked into diesel fuel, those are selling for $8 or $9 above Brent prices right now.
Russian crude is selling at $89 above Brent.
Not Russian. Other countries, because Russia obviously has a price cap, etc. But they are selling for it about $85 for their heavier crude distillates. But Russia is a totally different story because of the price caps and things of that nature, and because they've had a very large discount to the Brent. But I'm talking about like OPEC, other OPEC countries that are selling. In fact, we just had Saudi Arabia come out this week, and they're selling OSP, which is, their official selling price is above Brent, and they're selling that across Europe and Asia and to the US.
Yes, and that is a perfect segue into our next subject, which is tumbling crude prices. So as you were just talking about, as we've talked about for several weeks, our most visible discussion about this was crude not hitting $100. That was about a month ago. And we've seen crude fall $10 this week, and I've got the light sweet futures on the screen. So can you tell us, kind of in addition to what you were just saying, can you tell us what's happening and how far do you expect it to go?
Well, I mean, I think it's because we had such an initial every reaction creates an equal and opposite reaction, right? So we had that kick up to 95, almost $100 on Brent, $95 on WTI. And that was just a major, that was a major chase on push up, CTA following people, got on the trade, et cetera, et
Positioning.
cetera. And then, it's a momentum, it's a Momo trade, right? And CTA, when you have CTA traders, they tend to jump on any momentum, no matter what product that is. And so that pushed prices to what levels that were where they really probably shouldn't have been. I mean, they don't need to be that high. That's really terrible. When we saw prices push up to $95, that is terrible for refiners. We saw margins collapse. And so, you knew immediately these prices were too high and that we would have to see oil prices come down again, because it was just awful for the industry. In general, it's horrible on emerging markets, especially with the dollar pushing up and you have dollar denominated debt, and then you have pressure of oil prices being high. I mean, it was a terrible scenario. And so it's not surprising that we have seen a pullback. Has this pullback been more exaggerated than it likely should have been? Probably. But, I think what we really need is stability in oil prices, because what happens is when you have this volatility in oil prices, this does not encourage producers to go out and spend money on new wells and new production, et cetera, where they're going to hold up. And that, in the end, this is going to hurt us in the long term, because they're going to be like, oil prices are too volatile. We're not going to invest in, we're not going to invest in new production right now. We just can't. We don't know what oil prices will be tomorrow. And so in the long run, this is, adds to the theory that there's longer for, higher oil prices for later, because we're going to see demand increase. Regardless if we see demand decrease in the West, we're still seeing demand increasing in, say, again, emerging markets, Asia in particular. So, I think right now, what we really need is some sort of stability in oil prices. And so that encourages producers to at least start producing a little more to keep up with demand, so it's not becomes crushing later on.
Okay, so how low do we go, and what is that stability in oil price? Because I don't think those two numbers are the same.
Well, I think, I think this, I think $80-90 range for right now is great. I think OPEC would be thrilled with that.
That's what I've been saying. OPEC, I think that's
would be thrilled with that. How low does it go right now? I don't know how long. I don't know how low. We've seen this sell off. This drastic sell off reside over the last couple of days. We've seen oil prices here stabilizing a bit today and yesterday, even though we had a little bit more of a sell-off. So I don't know. I think, if you're looking at $79, I would be a long-term buyer there for a swing higher.
Albert's drooling.
But but I'm not saying that it can't, here is not a bad level either. So,
right.
I think, and Tony, I think the oil markets are telling you that, because the oil markets have stabilized again over the last couple of days. Yeah, we're kind of moving sideways over the last couple of days, but that drastic sell-off is kind of over. And I think people are kind of done.
OPEC's happy where we are, mid-80s, low to mid-80s. Dollar is happy where we are, 106. Is the world happy with where the dollar is? No.
No. I mean,
I'll leave the dollar up to Albert.
I would love to see oil go back down to 75 to 77.
That's my call. I think the buyers step aside long enough to get it down there.
Yeah, I just don't buy into these. Like, I mean, last week we were talking to a couple of guys, and everyone last week was like, 120 coming, 150 coming. I don't buy into these extreme moves. I mean, especially when you have OPEC and the Fed playing all these games. It's like they're not stupid. Saudis don't want it over 100. The U.S. doesn't want it under 65. So, you pick a range 75 to 90, 95. Like, I mean, we've been talking about that for how long, Tracy? Year?
Months.
Year almost. It's such a nice sweet spot for everybody. I mean, they can do whatever they want with their CPI prints of crushing it down to 75. They'll make the Saudis happy at 90. Ping pong back and forth, and I see it sitting there for quite a long time, to be honest with you.
That's good. We need that. We need some stability, right? Some price stability.
Yeah, but it's
Absolutely.
it's crazy though, because
I
you
mean-
look at these 6% drops the other day. It's like that's
It's
like, what is this? Bitcoin? Is that what we are now? Oil is the Bitcoin market?
Yes.
6-7% drops.
You
That's
need
insane.
you need stability in the oil market. And I think people, if you're looking at oil equities in particular, if you're trading those, that's what you need to see. You don't need to see this volatility does not help investors, and it does not help producers.
It doesn't even help. It doesn't
Nor
even help.
downstream.
It doesn't even help the shipping. Like, by the time you ship something 2 months later, you could have a drastic swing of like $15 on some of your oil. Now, that's way over my head, but I've heard complaints where traders had to like hedge because they have ships out to sea.
Oh, absolutely.
Yep.
Oh.
I think of OPEC just like the Fed. OPEC with these announcements that they've made more frequently this year than I can recall in the more recent past. It's helped to create, I should say, the volatility, in the energy market in the same way that, the Fed with their ongoing, just every day of every week post an FOMC meeting, we just get these wild swings in the equity markets. It's realized volatility in the equity markets, not so much in the VIX, which is implied. But that's how we've had these 6% positive swings in crude in Brent, and then you get the adverse effect as well, kind of mean reversion. But both of these entities with their press conferences and their press releases here and there and interviews with Saudi members and what have you, it's helping to sustain the volatility that really does not need to be there and is not productive.
And it's not helpful for consumers, right?
Right.
Of course.
People freak out about oil for a few weeks, or gasoline prices, petrol prices for a few weeks, and then they're relieved. And then they freak out, and then they're relieved. And it's just uncertainty at the consumer level. So, okay, so good, thanks, guys. So let's change the topic to a completely ridiculous one, which is a clown show that we call Washington, D.C. We're going to talk about DC drama and markets. We've seen a lot of drama in DC this week. US politics just doesn't seem to make sense to foreigners, really. But Americans are kind of inured to this. Government closures, House leadership contests, all this stuff. We care, but we don't care. I could be wrong on that, but I think every day we're just washed over with this news, and I don't know that it really makes that much emotional sense to us anymore. So can you tell us why the Speaker of the House is such an important role in Congress? And really, let's dig into that a little bit. And also, where is the American mind on this? Because we have some people from overseas who watch this, and they're hearing that this was the first Speaker of the House that was let go, outside of an election in 150 years or something. I don't know. But I don't know that most Americans really care all that much because of the drama that's coming out of DC every day.
Yeah, I mean, McCarthy was hated from both sides. It took him like 24 votes to get elected Speaker the first time
15,
around. Yeah, and it was a deal between 7 or 8 GOP members with McCarthy saying, do
Right.
this, otherwise we're going to vacate you. Yeah. And McCarthy thought, and actually a lot of the congressional members that I talked to thought that he was going to be able to survive this. And last week I'm sitting there calling for shutdown because I didn't think it would be that dumb to work with the Democrats and face vacation. So now, his famous tweet, "Bring it on." They brought it, and he's gone and not gonna run again. And this is actually worse than a shutdown, in my opinion, because now we have a contentious speakership of between 3 individuals: Scalise, which is basically McCarthy 2.0, Tom Emmer, which I'm not a big fan of him and his ridiculous Bitcoin antics, and I don't even know who else would be. Jordan's not going to make it. He's not going to do it. So I would probably say Scalise or Emmer are the top 2 guys.
You know who Emmer is, and and I pay attention to this stuff.
Yeah, so I would say it's problematic because the Speaker is used as the mechanism to bring floor votes, to whip up the majority, find the votes, and pass bills. right? We have seven appropriations bills that need to get passed, and one has to be reworked, all before 40 days comes up and a new shutdown deadline looms, right? And the House is not even in session for another week. So take 10 days of that away, you have 30 days to somehow get appropriations bill that funds the government through. This is, like I said, this is so much worse than a shutdown at the moment. I would rather have a week shutdown and some compromise been found and then get back to the table and get back to work, rather than now we have a speakership race between three monkeys that really shouldn't even be there in the speakership, saying ridiculous things and throwing out Trump's name left and right. This is just an absurd clown show that we're having at the moment.
Is it feasible that Trump becomes a speaker? Yes or no?
Absolutely not. I don't want to even hear that stupidity.
I wanted to ask that, Tony.
Oh, sorry, Tracy.
Twitter for the
I
last
think you were
2 days.
plotting Albert there.
Twitter for the last 2 days have been like, hey,
You guys are just trying to give me a heart attack. That's what y'all are doing.
I
Trump
asked
has no
a
chance.
question about it, and
Trump has no chance to be speaker, nor should he even be speaker. He doesn't know anything about the mechanism about being a speaker. It would be nothing more than a campaign ad for the next 7 months.
Yep.
This is a stupid idea put on by stupid grifters that were trying to get into Trump's favor for the 2024 election. That's all it is.
Albert, so let me, and I was just talking about this yesterday with somebody in Asia. The Americans see someone like Dianne Feinstein, who made $150,000 salary for 35 years in the Senate, but passed away with $110 million estate. Okay, that is I think, a perfect example of how Americans view people in Congress, House or Senate, and how they go to Congress as relatively normal people. And then emerge these multi-millionaires. So the frustration,
They're all extortionists.
exactly.
Don't vote them in. Don't
They're
vote them in.
extortionists. Well,
If you got a
anytime,
problem, if you have a problem about your congressional member making $10 million every 5 years, don't vote them in. I don't understand what the people
My
are talking
congressional member is Dan
what are we
Crenshaw.
going to do about MTV's Rock the Vote then?
Right.
Yeah.
My congressional
Dan
member is
Crenshaw is
Dan
a moron.
Crenshaw. I complain.
Dan Crenshaw is nothing more than a corporate shill. He's a
That's
corporate
right.
shill. Yeah.
And I can't get
Don't vote him in.
but why
So-
do people keep voting these people in? This is what I don't.
Because
Mitch and
these
Nancy and
Because
This-
every
I
election
feel we're
cycle,
doing our civic duty. I mean,
every election
anytime
cycle, he says Navy
anytime we
SEAL.
get to the conversation of politics, I always go back to the same thing. When was the last two-party system that has succeeded in perpetuity for its population? Mic drop, because it should be silence after that. This we get to a certain tipping point, if you will,
Yep.
where the structure of the system just doesn't work to the benefit of the average person. The other aspect of it, and why, in my opinion, it's become so contentious, in the turn of the century, is I think if you go back to the great financial crisis, right, we were already in a deficit, but that compounded the deficit, and then you get the pandemic, and there's no win here for politicians. When you have a deficit this entrenched, what can you really do? You're really just appeasing that guy who appeases that guy. It's all a chain of appeasement at this point, because we're not paying our bills one way or the other at the end of the day. We to come out of this, 31, 32, 33 trillion dollars. So it's, who can I appease best, and can I amass, a certain, population of people where I can get elected. But then it's just still, it's about appeasement. And at some point, it just becomes unsatisfactory to the general population.
Okay.
And we're at the point where there's no such thing as bipartisanship on a real, continuum. It just doesn't.
Bipartisanship is dead.
So
It's
with
dead.
that, okay, Albert, given what Seth said, does whoever the speaker is even matter?
Not really. Not in this day and age. It's more about groups within each party that are in control of something. I mean, the
There's too much
Democrats.
bifurcation within the parties.
Yeah, the Democrats are more unified than the GOP at the moment, because it's Trump versus the Trump GOP versus the rest of the GOP, and they're simply not unified nor nor are they going to be unified.
But I would argue you even have schisms. So I don't believe we have a two-party system. I believe we have parties within parties, right? And so
Yeah,
we have the Trump
But
party,
you
the
still
Trump
need a
party, and
majority
all this
vote.
stuff. And you even have people like Marjorie Taylor Greene who are at odds with Matt Gaetz or at odds with Lauren Boebert, and these are all Trump people, right? So it's not necessarily two parties. There are kind of Bolsheviks and Mensheviks within each party. Sorry for the
So you get stalemates. You get Mexican standoffs and stalemates in perpetuity, year after year after year.
I would gladly take stalemates with this clown Congress. Gladly, would I have still, because honestly, if you're a corporation and you're trying to do a 5-year to 10-year outlook, I would rather have stable stalemates than extreme policies on the left and the right every time a new Congress gets elected in. It's just,
is that
you could just take line items out of the budget. You could just take line items like they did with the departments of weight and measures. When was the last time you saw the departments of weight and measures in the congressional budget line items? It hasn't existed since 2014. Why hasn't it existed since 2014? Because Amazon literally pays fines to equate to their entire budget. So just find other companies that will satisfy that as well. But
I had no idea about that, Seth. That's amazing.
Me neither. That's insane.
So Albert, so is this kind of intractable environment one that actually creates some sort of stability for, say, the private sector?
no,
No.
only because we don't have normal, logical economic or fiscal policies in act right now. We have insane things going on at the Fed and the Treasury and out of the White House. So we don't have anything normal happening. So why would we have no chance to fix it? That's the problem that I'm seeing going forward. We have dumb EPA rules. We have dumb immigration rules. We have dumb foreign policy. We have dumb economic policy. So until we actually have like a decent congressional opposition to the White House, nothing's going to get fixed. Nothing's going to get resolved.
Does this change before, say, 2030? I mean, is this a generational thing where we're waiting for baby boomers to,
I think we have to lower our expectations.
No, baby boomers are checked out. They're checked out. They're cashing out of this market.
But they're still
this
voting.
market's being this
We
this
need
this
Gen
market
X to step up, people.
Amen,
This is
sister.
what we need.
boomers
They're
are using
gigging it,
these
though. They're
market
gigging it.
rallies. Boomers are using these market rallies for exit liquidity on the backs of millennials and Gen Z, where the Gen X are going to have to step up and run the show for whatever's left until the Marxists and progressives are coming out of
Right.
college and run things. That's just the way it is, and it's a cyclical thing. I'm not even complaining about it. It's a cyclical thing. It happens in every society, every government. You have extreme right, extreme left, and then it falls back in the center a decade or two later.
Okay, so there will be a speaker, right? It will not be
Yes.
Donald Trump, but we will have a speaker.
Oh yeah, for sure.
Right? Okay,
Within 2
that
weeks.
will happen
2
by
weeks.
next week or something, right?
Yeah.
Okay, and that person is just really a tool to serve as a traffic light for things to work in the House. That's all.
That's right. That's right.
Okay, and so once that is in, we have I kind of like a legislature that can't do that much. So what does that mean when this person is in? Are they, full steam ahead making legislation that we all can't stand, or is it a minimalist legislative body where there's so much disagreement that very little gets through?
It depends on who's running the show. If it's Jim Jordan, nothing's going to happen at all whatsoever. Right? If it's Scalise, it'll be status quo for what McCarthy was doing. Yeah, we'll get some stuff done here and there. If it's Tom Emmer, I think it's probably a little bit more efficient from the GOP side.
Okay, so
Just
not who do you want to win, but who do you think would be the best to win for kind of the functioning of that legislative body? Is it Tom Emmer?
No, I think it'd be Scalise. As much as I don't like it, it's Scalise.
Okay,
Status quo. Yeah.
status quo. Okay,
Better the devil you know than the devil you don't know, right?
Well, that's the thing. That's always the case. With Russia and Putin, everyone, DOD guys say, "Oh, we can get rid of him." Like, well, who's coming next? You have no idea.
Yeah.
I know what Scalise is going to do. I don't know what Jim Jordan's going to do. God knows what he's going to do. So that's just the reality of it.
interesting. Such is American politics. Guys, thank you so much for this week. This is great. Really appreciate your thoughts. Have a great weekend. Have a great week ahead. Thanks, guys.
Thanks, guys.
Take care.
That's it for this week's episode of The Week Ahead. Please don't forget to rate us and review on whatever platform you are watching or listening to this. Thank you.